Hey listeners, I just hosted Max Resnick, the lead economist at Anza. Max worked in the Ethereum research world and became a bit of a vocal critic of Ethereum's culture before jumping ship and joining Anza, which is the developer shop that develops Solana, at the end of 2024. In this one, we really get into market structure and how Solana is trying to deliver on this idea of internet capital markets at a more granular level. It's an interesting window into what folks at Anza are thinking about as they work to deliver on things like Alpenglow, a major upgrade coming to the Solana protocol. This is a good one. Let's get into it. This episode is brought to you by Katana, a DeFi-first chain built for deep liquidity and high yield. You'll be hearing more from them later in the show. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubanek, joined today in the studio by Max Resnick, Maximum Resnick as he's sometimes known, the lead economist at Anza, friend of the pod. Max, thanks for joining me today.
Thanks for having me. Thanks for having me back. I think last time I was on was like day one of me at Solana at Anza. So
Yep. Yeah. I just checked. It aired on Christmas Eve of 2024. So yeah, it was. People loved it. But it's interesting because back then there was only things we could talk about hypothetically about what you would do at Anza. So now there's much more tangible kind of things we can speak about. Before we get into all that stuff, permissionless. By the time you hear this, I guess it will be the week of permissionless. But would love to see a lot of you come out there. I've been promoting this thing a lot on the pod, and it would be great to get to see some of you in person. There's going to be a dunk tank. There's going to be happy hours. I've just today learned that the dunk tank and the happy hour are going to be concurrent, multiple concurrent dunk tanks, if you will. See, it all connects.
I'll be there. I'll be debating some people.
Yes, yeah. I don't know if you know this, but I was kind of behind that debate.
Sweet. Which one?
I proposed it. I can't remember what it is, but I remember being like Max Resnick would be good.
Oh, sweet.
It's something. Is it like the whole world will be on one computer?
Oh, yeah, that's a good one. It's going to be with Uma. That'll be good.
Yeah. I pitched that debate and it made it through. So that's my contribution to the subject matter of permissionless. But yeah, Max will be there. I will be there. Come find us. Come chat with us. Should be a good time. Also, one other housekeeping piece before we dive in. We are doing a survey for some, stuff we may use for an article, stuff we might use in Lightspeed, where we're surveying Solana folks on what they think of the top 20 or so tokens. Are you bullish? Are you bearish? So that'll be in the show notes. It'll take like 2 minutes to fill out. It's kind of a fun one. Maybe I'll get Max to fill it out after this. Get his real thoughts on the, Pengus and the Solayers and whatever else is out there these days.
All I can say is that Fartcoin is digital natural gas, and so I'm very bullish on that.
I mean, if you've bet against Fartcoin at any point, you've been sadly wrong. But that's all our housekeeping for today. Max, shall we get into it?
Let's go.
I guess maybe just to start out, I think sometimes we don't define our terms well. So just explain to me what Anza is and what it means to be the lead economist there.
Yeah, it's an interesting title. First, starting with Anza, we are an organization mostly consisting of people who've been longtime Solana core devs, so who started out at Labs and built the original Solana Labs client. And then about a year and a half ago at this point, they made the decision, I wasn't there at the time, to split off into a separate entity so that entity could focus solely on IBRL type of things and not have any distractions and be really laser focused on making the Solana client and the network run as fast as possible and as well as possible. So basically all the devs moved over there, and I'm, one of a handful of new hires that have been brought in, but most of the people are people who've been working on Solana for 4 years who've been through all of it. And my role is in some ways a generalist in that my specialty is in economics and game theory. And so there's definitely some work that's like directly in my specialty, like figuring out how the rewards are going to work for voting, etc. Then I have a lot of background in MEV. So when we talk about transaction landing and the scheduler, I have a lot of input there as well. But then there's other areas where, on the face of it, I have no expertise, but I just, look at it and get into it. And everybody at Anza kind of has to roll up their sleeves, and the problems are really complicated and hard. But if you roll up your sleeves, you can solve them. So that's kind of the culture that we have, is kind of a dirty jobs type of culture for getting into the weeds and solving hard problems.
You alluded to figuring out rewards for Alpenglow, the new consensus upgrade that's forthcoming. We had Brennan on the pod a couple weeks ago at this point, but yeah, are there any updates about Alpenglow? How's progress going? What's proved to be more difficult than you expected? Or yeah, I'm just curious to hear how things are going with that.
Yeah, I think it's, for me, very surprising how fast things are moving. I think we had this meeting in January where we had the first discussion and unveiled the original version of the protocol. And I was like, oh, great, this will be, a 4-year thing or whatever. But then on April 1st, we had our first internal DevNet running, hooked up to Agave, not just like a skeleton that only runs the consensus, but fully hooked up. And we had another iteration of the consensus mechanism that was even faster than the previous one. And now we have that running internally on DevNet, hooked up to Agave, not just, the consensus prototype, but fully integrated with the rest of the system. And, the timeline that we're looking at right now is we're really hoping to be on Solana testnet by December, hopefully by Breakpoint, which is in December in Abu Dhabi. And then we're hoping if everything goes well, then we'll be launching early next year.
Nice. Alpenglow has been achieved internally. You should tweet that. That would do numbers.
I think Brennan already tweeted that yesterday.
Come on. Well, great minds think alike, I guess. I'm curious to hear. We've talked about this in the past, but just the evolution of Anza and sort of the maturing of the Solana protocol to where there was, I think, a lot of putting out of fires when you had this very quickly constructed blockchain that had to, get out in time to appease VCs and so forth in 2020. And now 5 years later is really like rethinking some very core things. And it probably takes quite a bit of duct taping stuff together before you're able to like rebuild the engine mid-flight. So just as you've gotten settled at Anza, what have you seen on the maturing of Solana at like a code level?
Yeah, I mean, so like just at first, like in 2020, it wasn't that they had to appease VCs; they were running out of money. They had to get it out the door because they were running out of money. And so they just launched. They put the duct tape on and they launched what they had, and here we are. So thank God they did that. But the Solana network is maturing a lot. I would say there are really concrete things you can point to. Like, for example, we now enforce the CU limit on blocks, which is something that we didn't do before, which of course you should be doing. We now are, we're looking at making explicit transaction headers and block headers. And these are just signs of like, you don't do those when everything is on fire. Those are things that you only get to, they're very important to do for like ease of use and feature improvement and debugging and all this kind of readability, but you don't do them when everything's on fire. And so I think we're getting to that point where we're finally able to make major pushes on things like asynchronous execution and make these kind of what are quality of life changes, but they're like major quality of life because they make it so that we can actually develop a longer term like roadmap long into the future without running into all sorts of issues, right? Like you don't want a type of development where you're fixing a problem and then 6 months later you have to come back to that thing. That's will really slow us down. And I think we're finally getting to the point where we don't have to do that anymore. Like we're just like looking at each individual, we call it the perf audit, performance audit. And what we do, we bring in the artillery like Alessandro. They look at the code, a specific section of the code, and then from first principles, hitting it with the profile or looking at what's actually going on, they redesign it completely. And then hopefully we don't have to come back to that because we design it like for way more throughput than we expect it to need. Then we don't need to come back and fight a fire there later. And that's what's been happening. And it's finally happened to enough parts of the protocol recently on Turbine, which is kind of mission critical for dissemination, that we don't have to go back and revisit those things anymore. And it's making everybody's life a lot easier.
Thanks to Katana for sponsoring this episode. Looking for the next big chain? Katana isn't yet another new general purpose blockchain. It's purpose-built for DeFi users and focused on giving the best experience possible. It does this by sustainably generating deep liquidity and high yield. If your assets are sitting idle, they're dead. Katana is built from the ground up with DeFi mechanics to bring your bags back to life. All you have to do is bridge over and Katana does the rest of the work for you. Incubated by Polygon Labs and GSR, Katana launches with a notable ecosystem of primitives, assets, and partners, including Morpho, Sushi, Vertex, Lombard, Chainlink, and Yearn. Be early to Katana. Join the pre-deposit campaign before mainnet opens at the end of this month. Deposit funds and open rewards filled with randomized amounts of CAT tokens. There's also a CryptoPunk and other exclusive NFTs hidden for some lucky depositors. Thanks again to Katana. Solana's been hot lately, but you can truly never fade Bitcoin. Are you a Solana user who wants to get exposure to Bitcoin? Mint zenBTC to get that Bitcoin exposure with yield and some rewards to boot. zenBTC is the first application launched on Zenrock, a permissionless decentralized custody network backed by One Roundtable partners, 10T, Maven 11, and Spartan. Live on Jupiter, ROC is the native token for transactions within the Zenrock ecosystem and secures Zenrock's decentralized custody network. zenBTC is secured by Zenrock Decentralized Custody, and it ensures that Bitcoin holders can securely and seamlessly earn yield on their favorite chain, like Solana. Visit zenbtc.io to learn about earning yield with Bitcoin on Solana. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. A few months ago, probably at this point, you had a pretty interesting blog post that you co-wrote with Anatoly, the co-founder of Solana. So congrats, big moment. But you kind of talk about how this vision of internet capital markets where lots and lots of trading and financial services come onto Solana is going to require multiple concurrent leaders to happen, basically. And to demonstrate this, you sort of tell a story about market structure and how market structure works on Solana and can create some adverse selection at times. So maybe just walk me through that story of how market structure works on Solana, why there's problems to that, and maybe if we get to it, why multiple concurrent leaders need to happen as well.
For a long time, we've been doing things in TradFi with these order books. And so when Anatoly and co came up with Solana, they said, we're going to build a blockchain that's fast enough to put an order book on chain. And the original version of that was Serum. And it actually worked pretty well for a while because the validators were running the code that was given to them by labs. They weren't, modifying it in any way. And the traffic was low enough that none of the queues, which would eventually become saturated and break everything, were being saturated originally. And then quickly after that, once activity started to hit the chain, this started to break down. And like Serum, when the token pumped, was doing it was like 150 mil of daily volume, but the token was, pumping like crazy. And so everybody knew about Serum, but I don't think it ever really worked as well as we had hoped. Okay. And then there's another iteration of these kind of things, which is...
And Serum was like a DEX created by FTX, right? On top of Solana in the early days.
I don't know if it was exactly... Yeah, there were, I think, former FTX people did it, and there was clearly some close relationship, although I don't know exactly the details of how that was structured. I wasn't even on Solana at the time, but yeah. So that was like basically the original vision was like, make this fast blockchain, stick what works for traditional, central limit order book markets on centralized servers on Solana, and hopefully we're fast and cheap enough to serve it. And it didn't really work. And partly didn't work because there were a bunch of bugs in the code. And so it wasn't as fast and cheap as we had hoped. And there was a bunch of like weird things with queues getting overloaded and buffers getting overloaded and all these types of things that happen when you duct tape this thing together and put it out. And then we had another iteration of this, which I think was Phoenix, which was by the Ellipsis guys. And it was also an order book. And they were doing some interesting things, like they had a crank that you didn't have to do transfers every time, which are pretty expensive. And we've had a few more iterations on the order book regime. But what it looks like today, and this is what I was going on a tirade about on Twitter today, is that CLOBs don't make sense for a blockchain market. And so everybody's talking about who's going to make the best CLOB. And what's actually the best market structure for Solana might not be a CLOB. But what we do care about, what we are optimizing for, and what I said in that blog post is we are optimizing for tight spreads and tons of liquidity, and to become the best place to trade for users all over the world, and eventually to be the default place for price discovery. But in that order, we're not going to try and you don't put the cart before the horse and try to become a price discovery venue right away. So part of the things that are getting in the way of a CLOB working on Solana are these kind of MEV auction type of things, which batch everything up and then order things by priority. And turns out that gives disadvantages to market makers. Market makers are the people who put the quotes on the order book. They're the people who give tight liquidity. They're the people who serve traders. And if those people are not protected, then they can't quote as tightly. They have to widen out. And that's what leads to high spreads. And we obviously don't want high spreads. So
that's just another way of saying like worse prices. Like you're not going to get as good of a price when you want to trade as you would like to get.
Right. The spread is defined as the difference between the best bid and the best ask. And the wider it is, the more you have to pay to. Often we do these kind of simulations that are like a round trip trade simulation. So you trade one way and then trade back. And that can tell you like what the effective actual spread is. But even just looking at the book, you can see how wide the quotes are. Mm-hmm. And I guess what I would say is it's not order books that are quoting super tightly right now. It's these dark AMMs, SolFi, ZeroFi, Obrick. These are the guys that are really quoting surprisingly tight, at some points even tighter than Binance on the same pair. And my guess is if we could take those insights, which are currently being used on spot, so just like trading spot BTC, spot Sol, and we start to move them into order books, or not order books, and we start to move them into like other derivatives like perps and stuff, I think they'll perform really well there too. And it's just nobody's done that yet because it's been being built out in real time for spot. And sometimes these things have to evolve. Like it was a long time before we got perps on crypto after we had spot centralized exchanges. Similar, like we've had these awesome games going on with these dark AMMs that are quoting super tight, and we need to like now graduate those insights into derivatives as well. And I think it'll be like, even without protocol changes, I think it will do really well. Then once you add on the protocol changes that we're going to do, like MCP, like ACE, like all these things are coming as well, and the combination will be crazy. And I don't think that TradFi will be able to compete, honestly.
So this is slightly different, or maybe advanced thinking from where you were at the blog post, right? Because in that, you kind of just say, well, there's this race between the maker and taker. If the price changes suddenly, it's bad if the market maker loses a lot because they're losing money, and so they won't quote as tight of spreads. And so basically we need multiple concurrent leaders so that we can figure out a way to give the maker a head start so they win more of the time. But you're now combining that thinking, it sounds like, with we also need these like proprietary AMMs that are figuring out how to quote more tightly. Is that?
Yeah, I think right? You don't want to like pigeonhole yourself into thinking in terms of central limit order books. There is still, with these proprietary AMMs, the same dynamic of a race between makers and takers. It just so happens it's easier to lift quotes. It's cheaper to refill liquidity. There's a dynamic where the take orders are much more expensive in terms of CU, and The prioritization is in terms of like priority fee per CU. So all of these things are like very good for the market structure. And I think we want to like use all of the tools at our disposal to tackle the problem.
Can you walk me through though how multiple concurrent leaders allows you to do this kind of like maker protection, basically giving them a head start in the race? Because I thought that was like an interesting proposal you walked through that maybe I haven't heard a whole ton about. So it's probably worth talking about as well.
Yeah. So the core insight there is MEV is about two things. One of them is reordering, and the other one is inclusion. So you can choose whichever order to put your transactions in, and you can choose which transactions you want to include. It's really easy to actually take over ordering as the protocol. So if you're worried that people are extracting a ton of MEV by reordering transactions, you can enforce an ordering yourself. We receive the block, and instead of replaying it in the order that the leader packed it in, we sort it by priority fee and then replay it. This is perfectly legal. It does not break consensus in any way. FireDancer people are mad that that's a O log n, which is super linear according to them, algorithm to sort this thing. But in practice, that's pretty cheap. So you can really sort the block and order it however you want. What you can't control is with a single leader which transactions are included. Mm-hmm. So if you wanted to do an ordering rule that says, hey, look through the block, pull up all the cancel orders and put them on top, similar to what Hyperliquid does, then you can do that. It's just that a leader is not going to include the cancels. And that's what multi-proposer solves. It says like, hey, one leader is not including you, then go to a different leader and they'll include you. Mm-hmm. And it's a repeated game. So if somebody's not giving you good quality of service in this period, in the next periods, you're not going to send to them. So that's the core insight is like, hey, you want to prioritize cancels, you can do it in the protocol, but then the leader, seeing that you're doing that in the protocol, will choose not to include the cancels at all. And that's profitable for them to do.
We've also spoken about there's this maker-taker race. In your piece, you say that centralized exchange data shows that the market maker only wins that race 13% of the time to cancel before they can be picked off by a taker. Under like for like on-chain central limit order books on Solana, would that number be even lower? Is the market maker winning even less, or what do you understand about how that works right now?
So it's a little bit of a weird dynamic. Yes, it appears that the market maker is winning less of the time right now, but it's not exactly as clear, because the way that the schedulers work today in Solana is that they prioritize by priority fee per CU. So a large transaction has a lot of CU, and so it's a ratio that's a big thing on the denominator. The total priority fee that you pay gets divided among more CU, and you don't get as much priority in the scheduler. So if you're designing a market in this way, you can say, let's make the takes expensive and the cancels cheap. Mm-hmm. In terms of CU requested. And then even though these things are like paying the same priority fee, the cheap cancel will get prioritized for the same overall priority fee.
So that's what folks are doing right now to kind of solve this problem?
That's one of the tricks they're using.
Okay. But then explain to me why, and maybe this gets into bigger stuff about the CLOB wars or whatever, but you said that central limit order books on Solana just cannot work, or on like a general purpose blockchain cannot work, if I'm understanding you correctly. So
I don't want to say they can't work. I don't want to say they can't work. I want to say that there are better ways to do it than that.
Which are what?
Which I think are basically any system that works is going to have a few properties. One of them is, I think you're going to have resting liquidity that anybody can take, because the dynamics when you have the ability to pull the liquidity aren't so great. So like if you're just kind of an off-chain signer says you're allowed to take from this order or this pool, I don't think that's exactly going to lead to the most liquid markets. So that's a property that a CLOB has, but other things have too, which is there is resting liquidity that anybody can take at any time available for anybody. And then the other property is that there's active management and there's constant influx of new information. Because the thing that widens spreads is adverse selection. Adverse selection is information asymmetry. So if you have a system like Uniswap, like X times Y equals K market maker, there is zero new information coming on unless it is from an adverse selection trade hitting you. Mm-hmm. And so you're always paying as much as possible for new information. The systems that work well are going to have active managers who cheaply bring on the new information, whether that's through an oracle that updates quickly or through the market maker themselves bringing on the information. Those two properties, I think, are so active management and resting liquidity, I think, are two properties of good liquid markets that central limit order books have because people are actively managing their quotes on there. But also these dark AMMs have as well. And I think they do it better in an on-chain environment where every operation is orders of magnitude more expensive than it is on an order book. So like on an order book, you can very, very cheaply, like on a centralized exchange order book, you can very, very cheaply pick up all your quotes, move them to where the price is, and set them down. On Solana, it's cheap, but it's not that cheap, right? And so this does become a problem. And so you're kind of trying to specify this curve. You have maybe 10 ticks of depth. Now I'm using tick in a different sense here, but you have maybe 10 ticks of depth. You have to pick up all those ticks, pick up all those orders, lift them, move them slightly. And if you do that enough times, that gets expensive. And so what these dark AMMs do is they let you very cheaply pick up everything and move it without, replacing the quotes.
Okay. So maybe to summarize a lot or for a very basic level for people, like on the Solana L1, things are cheap. But if you're doing market makery stuff, you're making like a ton of transactions in a very short time span. So that is not as cheap as, say, if you're using a blockchain like Hyperliquid or Binance or something like this, where you don't have to communicate among as many validators. Like with increasing bandwidth, reducing latency, and Alpenglow and the things Solana has planned, do you ever foresee a world coming where CLOBs can work on just on the L1 without having to do like a roll up type thing?
Certainly possible. I think like if you do all the changes that we have scheduled, async execution, multi-leader, ACE, and then you increase the bandwidth, you increase the CU limit by 10x or something, probably pretty competitive with Hyperliquid already. But you might even be like, what I'm trying to say is this thing in TradFi, this whole world has basically been frozen in a block of ice. And the ice is the SEC. And when you try to ask the SEC to do something different, they say, no, that's unfair. No, the lobbyists told us that that's unfair, so we're going to tell you it's unfair. So like, for example, in 2019, CBOE, which is one of 3 or 4 largest exchanges in the world, asked to implement this asymmetric maker-taker advantage. And the SEC said, that's unfair. And the reason they said that's unfair is because all of the takers who stood to lose by this happening said, oh, this is unfair to us because we're going to lose money, even though it would have produced a better market structure, or at least that's what CBOE thought. And what we're trying to do on Solana is make it so that that is not an issue. So the SEC is not going to tell you what not to do because it's permissionless innovation. And the tech is suitable and flexible enough that you can do what you want to do on here. So nobody's getting in your way, not the tech and not the SEC. Like you can do what you want to do and experiment with new market structures and bring innovation into this completely frozen system. That's how we disrupt TradFi. Like, I don't know if Hyperliquid is going to be the thing that disrupts TradFi because it's so like similar. And it's pretty clear that there are better things you can do than central limit order book with no advantage. I think like Hyperliquid is an example of something that's slightly better than that. But what if you could do way better than that? And that's kind of what we're shooting for.
Does Hyperliquid do this maker taker race rules change thing?
Yeah, they do. They do.
Okay.
That's part of I think why they've been successful. Not the whole reason. They're I think a strong team and they've done a lot. And Jeff understands markets really well, but that's part of the reason. And I guess what I'm saying is there's no reason that for 30 years or whatever we've had this exact same market structure just with people getting faster and faster and faster. And now all of a sudden we found like this thing that's really, really close to that's optimal. I don't think so.
Yeah.
Probably if you think from first principles and you experiment and you do gradient descent, you're going to figure out things that are even better than what Hyperliquid's doing. And we hope that we're going to give the tools to developers on Solana to find that.
Do you think that this suite of upgrades that we've described, multi-leader asynchronous execution, the maker taker thing, all that together, is that the final form of like a market structure that could disrupt TradFi, or are there even more things that you think could change?
Well, at that point, it's up to the apps. So what I want to do when I got into crypto, like I think maybe 6 months after I got into crypto, there was this Uniswap v3 paper that came out that was groundbreaking at the time. But what actually happened is I hit this brick wall, which was partly the 12-second block times on Ethereum, partly the fact that there was PBS on Ethereum. Just nobody was quite fast enough. You couldn't control your ordering in the right way, and it was too expensive. I remember like doing dev in the height of DeFi summer. I wanted a contract, and I asked like the devs, like, can we do a logarithm here? And they said it's $5 every time we do a logarithm. I said, what are you talking about? Like, this is not the future of finance. It's $5 to do a logarithm. Like, we have to do a log to do all sorts of things in options pricing, etc. So obviously that was not ready. It was not baked. And so my goal in this whole initiative with multi-leader and everything is to make it so apps have all the tools. They don't have to go back to the drawing board. It's like, we say smart contracts are Turing complete, but you don't get to control your ordering. So it's in fact not enough to do what you need to do to innovate on market structure. And I think we're starting to get there with the level of capacity that's coming, that's already here on Solana, the level of fees that are already here on Solana. We're starting to see sparks of that with the dark AMMs, in that like this is a new thing that didn't necessarily exist before. And I think once we give them even more tools to control their own ordering, they're going to be like even more Cambrian explosion of new DeFi protocols.
Okay. Let's maybe talk about those dark AMMs, because it's a really interesting story. Basically, I think around the beginning of beginning of 2025, late 2024, somewhere in there, watchers of the Solana blockchain began to notice that these certain market makers were quoting really good spreads, like better than what kind of existed from the doxed market makers, shall we say. And so like a lot of Jupiter volume was flowing through this one called SolFi, and nobody knew who was behind SolFi. If you were running some kind of aggregator and you tried to work with SolFi, there's like one point of contact and it was very shadowy, like who you were working with, but they got really good prices. So they were like, very quickly began to eat up significant amount of DEX volumes, especially for things like Sol USD swaps, which are more liquid and less risky for a market maker to take on. It was eventually revealed a few weeks ago that Ellipsis Labs, which developed Phoenix, which you mentioned, and is now working on this thing called Atlas, has a very deep understanding of Solana market structure, was behind SolFi. There's other ones called like Obric or Orbic. There's ZeroFi. Those ones aren't public, but people have their guesses or whatever. But it's definitely been like an interesting trend where basically we're now seeing the rise of these proprietary DEXs where it's not open source code. People don't want to share their edge or their secret sauce they use to get really good prices. But it's, making a better user experience at the end of it, because Jupiter can route a lot of its order flow through these things and get better prices. So you kind of, apologies for the long-winded kind of explanation, but I think it's good context for listeners. But where do we go with these prop DEXs? Or with these things existing now, like how does that benefit DeFi or the market structure on Solana?
Well, I mean, it's already showing signs of being competitive even with Binance. Even right now we were arguing this morning on Twitter about this, and we ended up looking at the data, and it's like, yeah, SolFi right now is quoting like 0.66 bips, 0.66 hundredths of a percent wide, which if you count for the fees on Binance, which are like these asymmetric maker taker fees, and you actually properly account for like what that means for the actual spread on Binance, it's tighter than Binance. So that's like a sign of life, and like a pretty crazy, because a lot of what they're doing is pulling like price data from Binance. So you wouldn't think it's possible.
Interesting, yeah.
But it's actually just like, these are the kind of things you have to just look at the data, because if you start being a theorist and like, oh, there's no way you can pull the Binance data and make a market that's tighter than Binance, like, oh, they did it.
Yeah.
Shoot, all my priors went out the window, and you have to update like that. So my thought is like, it's time to just move those over to perps. And then this whole narrative of like, oh, Solana can't do perps, Solana can't do this, which maybe it's my fault because I put out that blog post, but like, I put out the blog post because like, this is a problem and we do need to fix it. And that's one of the differences between Solana and everywhere else is, you know, we're not focused on like, what should we say to like minimize the Twitter FUD? Like, we're focused on solving the problem, because we're not fighting ETH. We're not fighting Aptos or SUI. We're fighting NASDAQ. And so we're like the idea is not like, how do we go out and like present the best narrative for people who are already in crypto? It's like, how do we build the best product so that we can compete with TradFi and Binance? And, you know, that's the target. And so it's much more productive to say when things are wrong than to like keep them hidden and not put them out, because that's how you fix them the fastest. Like, imagine if during congestion, everybody on Solana was like, oh, there's no congestion. You know, it's kind of like very refreshing for me, because I'm somebody who likes to call out problems and likes to fix them. And when I was in my previous job, I called out some problems and everybody's like, there's no problem. Okay, there's a problem here, which is, you know, MEV, and it's causing spreads to be wider than we need them to be. And so let's solve it. And here's some solutions. What do we think about those? Are they good or not? Some good things, some bad things. Let's optimize the bad things and get them out. And that's very refreshing for me. And I think it's part of why Solana is going to win long term, because there's no ego.
Mm-hmm. No sacred cows.
No sacred cows. CLOBs are not a sacred cow for us. You know, we started out, CLOBs were a sacred cow. They're not. You know, we want liquid markets. That's the sacred cow. That's the goal. And whatever tools we need to achieve that. Imagine like a samurai was like, I refuse to use a gun because this sword is what I've been training for my whole life. It's like, no, the gun is better than the sword. You should use the gun.
So are you saying, just to recap, that like SolFi plus perps equals viable hyperliquid competitor?
We'll see. Like, somebody's going to do that. I don't know who, but like, it's worth a shot, right? I mean, there's a lot of other things that make hyperliquid successful.
Yeah.
But all I'm saying is, I don't think that the market structure today is going to be the thing that gets in the way of competitive with hyperliquid, because we already see in the data on spot, there's great things going on. I think we want to make some adjustments. Like, we are working really hard to make sure that landing is really reliable, that we have the option to do application specific sequencing. These are all things that we're working on. I think today, with all these with all the things we've discovered in the last 2 weeks that are not yet fixed, it's already going pretty well. And so it'll be really interesting to see, you know, in the last 2 weeks, we've been working really hard. We've been looking at send transaction, which is where some of the problems were, and just fixing a bunch of like really low hanging fruit. It'll be interesting to see when those go in, what things look like.
Thanks to Katana for sponsoring this episode. Looking for the next big chain? Katana isn't yet another new general purpose blockchain. It's purpose-built for DeFi users and focused on giving the best experience possible. It does this by sustainably generating deep liquidity and high yield. If your assets are sitting idle, they're dead. Katana is built from the ground up with DeFi mechanics to bring your bags back to life. All you have to do is bridge over, and Katana does the rest of the work for you. Incubated by Polygon Labs and GSR, Katana launches with a notable ecosystem of primitives, assets, and partners, including Morpho, Sushi, Vertex, Lombard, Chainlink, and Yearn. Be early to Katana. Join the pre-deposit campaign before mainnet opens at the end of this month. Deposit funds and open rewards filled with randomized amounts of CAT tokens. There's also a CryptoPunk and other exclusive NFTs hidden for some lucky depositors. Thanks again to Katana. Solana's been hot lately, but you can truly never fade Bitcoin. Are you a Solana user who wants to get exposure to Bitcoin? Mint zenBTC to get that Bitcoin exposure with yield and some rewards to boot. zenBTC is the first application launched on Zenrock, a permissionless decentralized custody network backed by One Roundtable partners, 10T, Maven 11, and Spartan. Live on Jupyter, ROC is the native token for transactions within the Zenrock ecosystem and secures Zenrock's decentralized custody network. zenBTC is secured by Zenrock Decentralized Custody, and it ensures that Bitcoin holders can securely and seamlessly earn yield on their favorite chain, like Solana. Visit zenbtc.io to learn about earning yield with Bitcoin on Solana. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. I was digging in to our last podcast episode, and one of the things you said you were looking forward to working on over at Anza was MEV. And MEV, I feel like, is something we talk about a little less in the Solana world than we used to. Sandwiching, I guess last summer, really came into the spotlight. Jito had some kind of blacklist where it would try to find sandwiching validators and blacklist them from using Jito's auction system. I think that is a little bit of a whack-a-mole game where it's hard to prevent validators from just spinning up another rig and like doing it all over again. But yeah, from where you stand now, how do you feel about the toxic MEV problem, how to think about or deal with MEV on Solana?
So I guess all of these things, and I think this is a common theme, is all of these things in market structure are details, details, details. And in this case, sandwiching was happening because landing was so bad that everybody was spraying their transactions to everybody. And so when you send your transaction to everybody, then some malicious guy is going to see it, even if they're only a small percentage of the network, and they're going to sandwich you. And so what was happening is, say some honest validator would be running Jito and they're not leaking the transaction. But because you sent your transaction four liters ahead, you sent it to some guy who is sandwiching, and he found the transaction, submitted as a Jito bundle in your block. And now it looks like you're the one who's doing the sandwich, but you're not. Like, it's just, we sprayed the transaction way too widely because landing was hard and this helped with landing and papered over some of the other bugs. And now, you can directly track how the targeting is in our metrics. We have tracking for targeting. We're actively working as the improvements are happening. The targeting is getting more precise. We're sending to fewer and fewer validators. And so a 10% stake that's sandwiching is able to see only 10% of the transactions, which is what it should be, right? But before it was, 10% of the stake sandwiching was able to see 90% of the transactions or whatever. And that was, so you look at sandwiching rates way down. And, shout out to ghost.xyz, who's one of the very few groups of people who are kind of like the open source intelligence for Solana. On ETH, they call it the dark forest. Mm-hmm. And Solana, there's just so much, there's 100 times more data. There's 5 times more volume. And there is like zero transparency in any way. And so the Ghost guys have been doing a ton of Ghost logs on Twitter, have been doing a ton of great work kind of like illuminating this. But I call it the black jungle because there's just zero transparency and nobody has any idea what's going on except the people who are actually trading. So it's really hard to figure it out. But once you do figure it out, it's like really interesting. And that's why these games with the dark AMMs, which I think we should probably not call them that because they call it dark pools in TradFi, and dark pools were actually great innovation that gave users way tighter spreads. But because they're called dark pools, people like regulators got really spooked about it. So maybe we'll just call them proprietary AMMs instead of dark AMMs. But those things are like just coming to light now in the public eye, but they've been going on for a year. Mm-hmm. And that's not the kind of thing that I guess would have happened in ETH land because there's there is, like, to their credit, a lot more transparency, and the game's kind of moved faster because of that. But yeah, there's probably something now that, you know, we're not talking about publicly that's going on that's going to be big in a year, because there is so much obscurity.
Probably this podcast being one of those things. But okay, a couple interesting things to dig into there. You said that there's a real lack of transparency with sandwiching reporting. Whose fault is that? Why is that the case?
Well, I mean, I think what Ghost Logs has done is make it really transparent. Like before them, like it was hard to tell. They rotate their addresses, so that could be hard. And then because of the targeting issue, you would see a sandwich transaction in a validator's block, and it wasn't necessarily their fault. They were just accepting the bundle from Jito, which was a sandwich bundle, and the transaction had leaked due to no fault of their own.
Interesting.
And so that was, you know, one of the first things I try to look at is, like, can we attribute to each validator which one is sandwiching? There was some ability to do that. A bunch of validators who are sibling the SFTP have been kicked off. So that's all been happening. Like, there's a ton of, like, little incremental things behind the scenes, and you look at the numbers and sandwiching is way down. And I think it will continue to go down in the future, because it's we have a lot of, like, regulated entities who don't want to be doing sandwiching. So it's like, it's not like Galaxy, which is a publicly traded company, wants to be sandwiching on the blockchain. They can't do that, right?
Yeah.
It's not worth it for them. And there are a ton of other companies like that who are running a lot of the stake. And so those are the same companies that are also operating on ETH, but on ETH, it's so socially accepted to sandwich. Like, nobody even talks about it on ETH. Everybody's sandwiching on ETH. Everybody who runs PBS is sandwiching on ETH, right? And on Solana, only 10% of the network is sandwiching, and we just happen to have way more volume. So it looks, you know, worse, but the problem is actually much better contained on Solana than on ETH.
This is really interesting. I haven't really heard this discussed before, but to summarize, are you saying that before it was difficult to land transactions, like a huge amount of transactions would revert, and so, or they would fail, and so you just had to spam a bunch to different validators in hopes that someone would want to include your transaction on the blockchain. Because of that, you're essentially, like, leaking your transaction to a bunch of different validators. So malicious validators who wanted to sandwich could pick up your transaction, sandwich it, and then include it in a Jito bundle. But that could go to a different validator?
Yeah, you would send to the Jito block engine. So say it's, you know, say there's a Blockworks validator, which is honest. And then there's another validator that's four leaders later.
The CoinDesk validator is
the CoinDesk validator. the bankless validator in 4 slots is sandwiching. The bankless validator sees the transaction that got sent to the next 4 leaders, including them.
Yeah.
And they make a sandwich bundle and they send to Jito. And then Jito sends to you as a bundle, and you include it as a bundle.
Yeah.
So you're not leaking the transaction.
Okay. So
but you're including the bundle because you're running Jito.
So now, if more transactions are succeeding instead of failing, there's not as much need to send your transaction to as many validators. And so it's easier to pinpoint who is doing the sandwiching. Is that what you're kind of saying?
Yeah, it's much because before the leader forward window was 3 or 4 or 100 if you're quick node, and now it's 1 or 2, and we think it'll be 0 soon, or at least if we get the changes that we're doing on send transaction right, so that you can just, like, also there was this thing where
so me, a sandwicher, I am seeing fewer transactions every day, so I just have less material to work with.
Yeah.
That's really interesting. I just haven't heard that explained.
So I mean, this is the kind of, I love working on Solana MEV because it's like hard mode MEV. And so I like ETH was a game where it was kind of obvious. The only surprise was the Telegram bots, but everything else was pretty obvious from day one if you started looking at it. Solana, it's like, there are definitely still things that I don't understand about the game, that it's constantly evolving. And it's like, that's fun for me, at least. It's like stimulating, and it's like challenge mode.
Mm-hmm.
I don't know how long it will look like that. I think part of the reason that it's exciting is because of all the bugs and all the tricks that you could do to get around the bugs and
Yeah.
everything. And I think if we fix those, it might get a lot more boring and a lot more like, this is the game. Everybody knows the game. Everybody can see 6 months out how the game is going to look based on how the game looks today. It's starting to settle down a little bit, but it's still a lot of fun. And I think in some ways, if it does settle down, it's kind of a sign of maturity. I just hope it settles down to something that is good for users and spreads and not bad for users and spreads like PBS is.
So if there's less sandwiching, there's less MEV rewards, right? Or fewer MEV rewards. Would that manifest in the data? Like, would we start to see like Solana's rev, for instance, dip because there's actually like, I mean, it's good, but there's less sandwiching going on?
No, I mean, if we turn on sandwiching for every validator, actually rewards would go way up.
Yeah.
And the thing about this dynamic where there's only 10% sandwiching is that Jito, like an auction, you only need 2 bidders to run an auction, but you need 2 bidders. If there's only one, then the equilibrium bid is 0. And so you can kind of look at this world of, did the transaction leak to a sandwicher? If so, did it leak to multiple sandwichers? The probability it leaked to multiple is actually pretty low.
Mm-hmm.
And so sandwich tips are really low. And the sandwicher keeps all of it. They don't give it to the validator, which is very different. Like on the ETH sandwiching game,
Yeah.
it's in the mempool. 10 sandwich bots see it. You all bid, and the bid goes up super high. In Solana world, it's like, are you in the leader schedule at the point where you saw the transaction? So, or are you the leader? And that doesn't necessarily like translate into high Jito bids.
Mm-hmm. This is just interesting because there was recently, for like a couple days, this debate on, you know, should we value blockchains based on REV? And the Blockworks guys were out, you know, shilling REV. But I guess from the Ethereum side, which totally does not have to do with the fact that its MEV is lower or its REV is lower, is basically making the argument that I don't want to represent it in bad faith, but some people would say for the Ethereum side that REV is not a good metric because it's just counting MEV largely, which is extractive from traders on Solana. So this is interesting context. If sandwiching is going down, then maybe like that MEV is not toxic MEV necessarily.
Well, but sandwiching was not, what I'm saying is even before this, just due to the dynamics of the game, the percentage of, there's some profit from the sandwich bundle, and you're the only, because there's 10% of the stake running this and there's 4 leaders that see the thing, conditional on you seeing the thing, the probability some other leader who's not part of your sandwich pool saw the thing is low. Yeah. And so the Jito bid corresponding to that is going to be low. And so you as a sandwicher keep 90% of the revenue and it doesn't show up in Blockworks REV dashboard at all.
Yeah.
So it's like, yeah, we're getting rid of sandwiching. Is that going to lower REV? No, it wasn't REV
it was never
anyway.
Part of it anyways.
And then I guess the other question is like, is this shit toxic to Solana? Like anything where you're paying a percentage of your trade sides is gonna lower overall activity on the chain.
Yeah.
I think the healthiest way for the chain to make money is to charge per transaction. So I want us to be 1 million TPS, as Dan Smith put in his tweet, 0.2 cents per transaction or something like that. And that's $60 billion a year. Mm. And we don't have to rake any traders based on their trade size. These are like, that to me is the healthiest way to collect revenue. And I think if you get rid of the toxic extraction, you end up with more of that type of activity, because there's just, you're taking a smaller piece of a much, much, much larger pie. Mm-hmm. And it's ironic to hear from the ETH people, because if you believe that MEV is really toxic, then you should try to get rid of it, which is what I'm trying to do. But you shouldn't just like leave it out there, like, and say like, oh, MEV is really toxic, let's like make it as easy as possible to extract MEV. It's like such a weird way of thinking about this, but I think it is correct. The predicate, which is MEV is really toxic, is true. We should get rid of it.
Get rid of MEV or get rid of sandwiching?
Get rid of sandwiching. I mean, we should get rid of all MEV. Like, it should all be like 0.2 cents per transaction, just a shit
Because
ton
if you just
of
get more
transactions.
efficient, you don't have to pay such a fee to get your transaction
I mean,
included first. or
it's
whatever.
not like any exchange is charging in the long run in TradFi. You can see how these multiples compress and how these fees compress. Like the exchange, New York Stock Exchange does not charge 50 basis points per trade. They don't charge anything in many cases, and they charge for the data, or they like that is, I think, where we want to get to be competitive with TradFi, because there are those competitive pressures. And so it's not going to work if we're just like some ordering thing is just taking so much money from the user every time. Yeah.
Mm-hmm. So long term, your ideal is that REV maybe shrinks on a relative basis, but there's just more transactions, and so like a little fees on a lot of transactions ends up being a lot of fees still.
Yeah. And I think it's going to be the fact that we are lowering. So, first of all, I believe that the blockchain should be valued by its revenues and its costs, because I'm not an idiot. Okay. I just happen to think that the best way to get the most revenue is, I think we're still in growth mode. And I think we need to, we have this one revenue stream, which is like reordering profits and sniping, etc. And some of that might be able to stay. Like, I think the pump stuff seems surprisingly sustainable for some reason. But the kind of raking your users who are trying to trade over the coals is not going to work, because they're just going to go somewhere else. If they have another option that's offering tighter spreads, they're going to go there. So we can't, that's not sustainable, because what will happen is that the apps will leave. The apps want to build a good competitive experience. And if Solana can't offer that, the apps are going to leave. But we can't offer that. It's just like partly an app skill issue, so we're trying to help them with that, but partly also a landing issue. And
it's their fault. Yeah. I mean, I don't necessarily know if users will leave for worse fees, because it's like it's been prophesied for years and years that Coinbase fees are going to go down, and Coinbase fees are still really high just because they have that distribution, and it turns out to be sticky. So I mean, you're seeing with like Axiom maybe that its success and the revenue sharing that it's sort of doing, and the way it's doing it as rebates instead of like a lower fee. But I don't know. I actually don't know if I would agree that, you can't rake your users over the coals. Maybe you shouldn't, but I think you can if you have a widely used app.
You definitely get some leeway when you have the distribution, but I don't think, like, Solana is not the distribution. Solana is the market. And so it may be the case that Phantom can charge their users 1% in perpetuity, but I don't think that's the game that we're playing at Solana. Like, Phantom might be very happy with that. But if you're on Phantom, you can click onto Monad. Well, maybe when they launch, you can click onto Monad, but like you can click onto Sui, and you can trade on Sui if you want. And so there is like, we have to be competitive in that sense. Like, we have competitive pressures there. Obviously, if you have user lock-in on your app, but even like Robinhood is giving, like, there are rakebacks, right? There are these types of things that it doesn't necessarily translate directly into like the fee, but you have rewards, you have points programs. All of these are ways that the user is getting a better price. And it depends on the market, like which one of those things the users like better. In credit cards, for example, I think there was a report out that I read last year that was like, if you look at how much Chase is having to spend on rewards points and everything, like their multiples are compressing, even though the fee on Amex is 3% still. It's like the Amex cards are competing with each other and giving back all the rewards anyway. Mm-hmm. And so, it might not show up directly, and like you still might have a swap fee, but then you might have, a kickback, and that's how it's going to work. If there is competition, the stuff, you can't just do this forever.
Interesting. Okay. We'll move on from that. So I want to ask you about inflation. This was a big topic that you and I have DM'd about a little bit here and there, but there was this big, early 2025 big discussion and proposal to change Solana's inflation schedule. Instead of being the current curve that it's on, to being more of a market-based mechanism, and in like if this thing were to actually be passed, lower the inflation. You sort of took on helping advocate for this thing. It ended up failing. It didn't have the proper quorum to pass, or whatever the right phrasing is there. But it sounds like you're still kind of the mind that inflation should be cut. You're overpaying basically for Solana security. So what's your latest thinking on SOL inflation?
Yeah, I mean, and just to be clear, 62% of the stake that voted for it. 75% of the stake voted, which is 50% more turnout than any vote ever in Solana. And 62% of those who voted yes, and only 38% voted no. So we had
66%.
We had a majority, just not quite enough to make it over the 66% threshold, which is pretty hard, especially when you're trying to lower inflation, and some people's businesses make a lot of money off of inflation. But my thoughts are the same, which is that inflation should go down. Again, I think that the way that it makes sense to value things is from fundamental perspective. And I laid out this leaky bucket of inflation, which is a combination of taxes and middlemen who are making, like, the US government is making a lot of money off Solana's inflation policy right now. On the order of, 200 to 400 million a year, depending on where the price is at any given time.
In taxes.
And we don't need to pay that, because we're paying ourselves, and the government is saying you're paying yourself. Like, we're creating new Solana tokens. That's the mechanism. You create some new tokens and you give them to people who already hold the tokens. And somehow the US government steps in because you're doing that and says, like, through some accounting wizardry, you have done this. Now we want our cut. And it doesn't need to be that way. And so the goal of, like, any of these things is cut costs. And when you're overpaying the US government for no reason, and the network is plenty secure, I mean, in many cases, we have more SOL, like, if you multiply the SOL stake times the price of SOL and compare it to the ETH stake times the price of ETH, in many cases we have more security on Solana in that sense. So why are we paying 6 times more than we need to, or whatever? I also think part of this discussion should be around the volatility of staking returns. So people have said, so I said, let's do something that's market-based. When REV is high and everybody wants to stake, obviously we should lower the inflation rate so that we pay the US government less. And when REV is low, we should bring it back up. And that was the proposal I had. And some people were worried that this dynamic would make validator returns more uncertain. And it actually makes it less uncertain, because it's a shock absorber, not like a shock amplifier. Like, if a shock happens in REV, Trump launches another coin and all of a sudden REV goes way up, everybody wants to stake, that REV brings the staking rewards up, and everybody coming into stake brings the actual returns to staking down because the inflation goes down. So it's actually a shock absorber, is not a shock amplifier. Mm-hmm. That was just a fundamental, like, mathematical misunderstanding from the critics. And
interesting.
I think it's, like, ultimately on us to, like, have explained that better. But next time we go in, I think we will have a much clearer explanation of all these things. And sometimes it's like, you know all these things, and then you don't realize that the person you're talking to is actually, like, a performance dev, and they know, like, a shit ton about networking, and they don't know about real versus nominal returns or whatever. And you just have to put things out in a much clearer way than we did. And I think if we do that, it will do better. I also think we'll do it a little bit more gradually. It'll probably be a 2-year rollout. It will be a gentler thing that we'll propose. And yeah, right now there's some governance infrastructure that's getting built. That's why we're kind of waiting, because last time we had this version of the vote where some people were a little unhappy that they had stake on a validator that they didn't get to vote. Mm-hmm. So we're just kind of hoping that infrastructure, which is getting built out by some teams, will be there, so that anybody who has stake can, like, you're staking with a validator, but you're not beholden to what that validator votes on that thing. You can vote your own stake as well.
Can you explain maybe the difference between, like, the real yield and the nominal yield. So as Blockworks would define it, I guess you have a nominal yield of 7 or 8% APY on staking. So like I will get a 7 or 8% return on my SOL if I stake today with a lot of validators. But not all of that is real yield because it doesn't actually come from like tips that are being paid to the validator that are then passed along to me. It comes from like inflation, which dilutes me. So can you just explain why it's not people maybe misunderstand what the nominal yield is versus the actual yield that you're getting for staking SOL?
Right. So suppose all of the SOL was staked and we made 5% new SOL every year and we distribute it to all the stakers. Now you have more SOL in your balance, but the fraction of the SOL supply that you have is the same.
Mm-hmm.
So it's the same way that if the US government prints a bunch of new money and rebases the dollar, like the US government could say everybody who holds a US dollar is going to get $2 in their account tomorrow. And nothing would happen other than that everybody would have to reprint their menus. And they would reprint their menu, they would double the prices, everybody's salary would get doubled, and we would go from there. And that's kind of like what happened when they printed a ton of money during COVID. And so that's the idea of real versus nominal yield. It's like real is after you account for the fact that there's been new issuance. That is, every time if you hold Solana in your account and Solana is inflating at 5% a year, then your fraction of the network is going down by 5% a year. And so you need to account for that in your ultimate, like, I'm holding this thing. What is my return on investment for holding this thing?
Mm-hmm. Yeah. Well said. And we can expect some kind of new, I know there's a proposal up right now from, I think, Galaxy Research that basically said, let's just let validators vote on how much to, lower the inflation rate. Do you have thoughts on that versus going with the market-based mechanism?
Well, I don't necessarily mind the idea. So it is a little bit of a technical challenge to do this thing where we have stakers kind of the ability to override the validator vote. So you stake with a validator, they vote. If you like it, you can let it sit. If you don't like it, you can vote a different way if you want to. There's a lot of stake accounts. Like I think there's over 1 million stake accounts. And so just the technology of like doing this is a little hard. And once you add in this, like you can specify some continuous value, it's even harder. So I don't mind the idea. I think it's like kind of nice it was a little bit contentious last time and I'm not sure it needed to be, but that's just how these things go. And because it was a binary outcome, it was super contentious.
Yeah.
And I think it might be a nice technology to like, we're all on the same page. Solana wins. It's just like we have some disagreements about the math or whatever.
Mm-hmm.
And if it was a continuum, maybe it would have been less contentious, which would be nice. It just, I think part of what we want to see is stakers being able to directly express their votes. And so we're hoping that comes soon. And then we'll likely bring a new proposal.
Great. Well, Max, I've taken up a lot of your time, so I'm going to send you out of here with one more question. We've talked a lot about the future ways that Solana is going to change, how you're going to live up to some of these mantras of increased bandwidth, reduced latency, internet capital markets, all that good stuff. To you, what is the one biggest problem? Like, what is the one thing that Solana needs to change from where things stand right now if it wants to build better DeFi, bring more people on chain, bring institutions in, all these kind of future things that you're talking about?
I mean, what I'm working on and spending 90% of my time on is can we get to multiple leaders? So that's obviously what I think is the biggest long-term threat. I think in the short term, we're doing really well relative to the competition in the short term, despite what you might see on Twitter. The metrics are looking good. We have, these new innovations that are quoting pretty tight. I'd like to see us compete directly on perps with maybe something that's specifically designed to work on a blockchain. And I think a lot of the perps teams are doing that. We've seen Drift, super active. Jupe thinking about it. We saw Ergonia, who's a big on-chain trader, announced on Twitter that they're thinking about getting into. They're doing some incubation for perps. So,
I haven't seen that. That's interesting.
So I think like in the short term, I'd love to see us like get really competitive on perps and win that market, because I think we have the tools and the distribution to win it over Hyperliquid. If we really put our heads down. And then in the long term, multi-leader, that's what I've been talking about for years, and I'm working on it. It's a big project, but we're making a surprising amount of progress. I'm much more optimistic than when I was in this podcast 6 months ago about the timeline, which is a good feeling.
Mm-hmm. Great. So short term perps, long term multiple concurrent leaders.
Yeah.
Max Resnick, live from the Blockworks office. Thank you so much for joining me, man.
Yeah, in office always. Thanks for having me.
Thank you everyone for watching. That is all we have for today. But please give us a 5-star, subscribe, like, wherever you get your podcasts. Follow us. We're on Twitter at LightspeedPodHQ. Give us a follow there for clips and all that good stuff. If you enjoyed this episode, please share it with a friend, and we will catch you again very soon.